investment. Today, we're talking about something that affects every corner of the financial world, the 10-year Treasury yield. Recently, we've seen it fall, and that drop isn't just a number. It has far-reaching implications for the economy, the stock market, and your personal finances. Whether you're a home buyer, investor, or simply someone trying to plan for the future, understanding why this yield matters can give you a real edge. We're going to break down what it means, how it affects borrowing costs, how it impacts markets, and what actions you might consider taking to benefit from these changes. By the end of this talk, you'll have a clear, practical understanding of why a falling 10-year Treasury yield is more than just financial news. It's a signal that can guide smart money decisions. The 10-year Treasury yield is one of the most closely watched indicators in finance because it essentially serves as the benchmark for long-term interest rates in the U.S. economy. When the yield falls, it signals that investors are moving money into safer assets like government bonds, often out of concern for economic growth or market volatility. A lower yield doesn't just affect Wall Street. It impacts the entire economy. It's the rate that influences mortgages, car loans, and even corporate borrowing costs. Essentially, investment acts like a thermometer for the financial world. A sharp drop can indicate that investors are nervous about the future, while a rise suggests confidence in growth and inflation. Investment. When you hear that the 10-year yield has fallen, it's a clue that market participants expect slower growth or lower inflation ahead. For individuals, this can translate to more affordable borrowing and cheaper mortgage rates, which can be a huge opportunity if you're looking to buy a home or refinance. On the flip side, it might also signal a cautious environment for businesses, meaning slower hiring or delayed investments. Understanding why the yield moves can give you an edge in planning your finances, because it's not just a number on a financial news ticker. It's a reflection of broader market sentiment and economic expectations. One of the most direct effects of a falling 10-year Treasury yield is on borrowing costs, especially for mortgages. Mortgage rates are closely tied to this yield. So when it declines, home loans often become cheaper. For someone looking to buy a house, investment, even a small drop in interest rates can save tens of thousands of dollars over the life of a mortgage. But it's not just homeowners who feel the impact. Businesses benefit too. Lower long-term rates mean that companies can borrow at cheaper costs for expansion, equipment purchases, or even refinancing existing debt. That can support economic growth if businesses decide to invest. On the other hand, a falling yield can also signal that investors are nervous about the economy, which could temper consumer confidence and slow spending. For potential homebuyers, this could create a window of opportunity to lock in a lower rate before lenders adjust to market conditions. For businesses, it might make certain projects more financially feasible. The key takeaway here is that a falling yield reduces borrowing costs across the economy, affecting mortgages, car loans, and corporate debt. It can stimulate activity in some sectors while signaling caution in others. Investment. So paying attention to these movements can help you make smarter financial decisions. A decline in the 10-year Treasury yield also influences the stock market. When yields drop, investors often view bonds as less attractive because the return on a safe government bond is lower. That can push money into equities, potentially boosting stock prices. Investment, particularly in sectors like utilities or consumer staples that offer steady dividends. Conversely, falling yields can also signal economic uncertainty, prompting cautious behavior among investors. Companies that rely heavily on borrowing may benefit from lower interest costs, while industries dependent on economic growth might see slower gains if investors expect a slowdown. For individual investors, the yield movement can guide portfolio decisions. For example, lower yields may make dividend-paying stocks more appealing, while high-growth companies that rely on financing might experience a temporary boost. Investment. Beyond stocks, it can affect other markets too, like real estate investment trusts or REITs, which often compete with bonds for income-seeking investors. Essentially, the 10-year yield serves as a benchmark that influences how capital flows across the financial system. A falling yield can be a subtle signal that it's time to reassess risk, diversify your portfolio, and consider how interest rate changes might impact the sectors you're invested in. Understanding this connection gives you a clearer picture of market dynamics and helps make more informed investment choices. Finally, investment. The movement of the 10-year Treasury yield has direct implications for your personal finances and investment strategy. Falling yields generally mean cheaper loans, which can encourage people to buy homes, refinance debt, and or make major purchases. But there's another side. When yields are low, savings accounts and other low risk investments often provide minimal returns, pushing investors to seek alternatives for growth. For retirees or anyone relying on fixed income, this environment may require adjustments to maintain a stable cash flow. In addition, understanding the yield trend can help you time investments more strategically. If yields are dropping due to economic concerns, it might be wise to focus on defensive investments or sectors less sensitive to market swings. On the other hand, investment. If you're in a position to take advantage of lower borrowing costs, it could be an opportunity to invest in property or expand your financial portfolio. It's all about balancing opportunity and caution. By monitoring the 10-year Treasury yield, you gain insight into broader economic trends and can align your personal finances accordingly. It's not just a statistic for economists or traders. It's a practical tool that, when interpreted correctly, can help you make smarter, more informed financial decisions that have real, tangible benefits for your life.